A Subchapter S Corporation is a corporation that is treated for tax purposes as a quote-unquote pass-through entity. Before the advent of limited liability companies in the 1990s, it was not unusual for a limited partnership to have as its sole general partner an S corporation, the shareholders of which corporation were the limited partners themselves. This had the effect not only of providing a limited liability shield for all of the owners of the given business venture, it also provided pass-through treatment for all of the business venture's profits and losses. This is because, despite its name, an S corporation is not a corporation, or at least it's not a corporation in the sense that it's subject to corporate income tax of the Internal Revenue Code. Instead, an S corporation is more like a partnership, at least for income tax purposes, with all the income, gain, deductions, losses, and credits that the S corporation recognizes passing through and being taxed directly to the shareholders themselves. Any eligible U.S. corporation can make the election to become an S corporation, so long as there are not more than 100 shareholders, all of whom must essentially be natural persons, and so long as the corporation only issues a single class of stock, the election can be made at any time, including from the moment of the corporation's existence. The hallmark of regular corporations, or C corporations, is that their income is taxed twice. Once, under Section 11 of the Internal Revenue Code, when the corporation recognizes the income, and then again when that income is distributed to the corporation's shareholders, typically in the form of taxable dividends. By electing to be an S corporation, this double taxation is avoided, with the shareholders themselves recognizing directly all of the S corporation's taxable income. This makes the S corporation a tax accounting entity as opposed to a tax-paying entity. That is to say, the S corporation must still account for its gross income, its deductions, and so on at the corporate level, but it passes those items through to its shareholders, who themselves pay the resulting tax. Indeed, except for a few specific circumstances, an S corporation itself is never subject to any federal income tax. As with partnerships, the character of the S corporation's tax items are maintained as they're passed through to the shareholders. This means, for example, that if the S corporation recognizes ordinary business income, then so do the shareholders. Similarly, if an S corporation recognizes long-term capital gain, or interest income, or deductions, then so do the shareholders. Recognize that long-term capital gain, interest income, etc. Importantly, for the most part, only individuals, in other words, natural persons, can be shareholders of an S corporation, and accordingly, an S corporation must account for its income, deductions, etc., in the same manner as in the case of an individual. Thus, while the S corporation must be a domestic corporation in order to be eligible to make the S election in the first place, it is otherwise not a corporation at all, or at least for tax purposes. Unlike partnerships, the pass-through income of an S corporation must be allocated among the shareholders strictly in a pro rata basis. Thus, a shareholder who owns 50% of an S corporation stock must personally take into account 50% of each item of S corporation income. On the one hand, this makes an S corporation an inflexible mechanism for allocating income among a business venture's owners. Partners in a partnership, by contrast, can allocate their venture's items of income and deduction amongst themselves in almost any way they see fit. On the other hand, with only one possible allocation scheme, Subchapter S has very little in the way of immense complexities that can be found with other types of ventures. And this relative simplicity can make the S corporation an attractive alternative for many taxpayers. Now let's turn to making the election. Any small business corporation may make the election to become an S corporation. We will look at what a small business corporation is a little bit later on. Before we get to that, let's focus on the election itself. First of all of the shareholders of the S corporation must consent to the election. This is sensible inasmuch as it is the shareholders who will, after the effective date of election, be responsible for any income tax that may arise with respect to the corporation's earnings. The election is made by filing with the IRS a Form 2553, Election by a Small Business Corporation. In addition to the vital details about the corporation itself, including its employer identification number, the date of incorporation, its address, etc., all of the shareholders' information also must be included on the election form. including their social security numbers and the percentage of stock in the corporation that they own. The election can be made for any tax year. Though once made, it's effective for all subsequent tax years unless it is voluntarily or involuntarily terminated. If the election is for a future tax year, the election can be made at any time prior to that effective year. If the election is for the current tax year, however, or if it is to be immediately effective, then the election must be made by the 15th day of the S corporation's third month. Thus, for an S corporation with a calendar tax year, which means a tax year ending on December 31st, the election for the first S corporation tax year must be made by March 15th of that tax year. Now let's define small business corporation. As we discussed earlier, any small business corporation can elect to be an S corp. The word small here doesn't refer to the amount of the corporation's earnings or the value of its assets. Rather, small refers to the limitation on the number of eligible shareholders, or 100. The S corporation itself really can be of any size in terms of its earnings and wealth. Specifically, a small business corporation is 1, not an ineligible domestic corporation, that 2, has a single class of stock, and 3, 100 or fewer shareholders, who 4, are natural persons, or certain types of estates or trusts, and 5, who are not non-resident aliens. Let's now take a look at each of these requirements. Requirement number 1, eligible domestic corporation. A domestic corporation is an entity that qualifies as a corporation and which was organized in a U.S. jurisdiction. Foreign or non-United States corporations cannot make an S election, therefore. Certain types of corporations, such as some financial institutions and insurance companies, also do not qualify. Note that the term corporation in this context doesn't even necessarily have to mean a corporation. It could also refer to certain other entities, like limited liability companies, that have made an election to be considered a corporation. Once that election is made by an entity like an LLC, it is considered a corporation for all federal tax purposes, including for purposes of making an S corp election, and thus an LLC can actually be an S corporation. Requirement 2, a single class of stock. Recall that shareholders of an S corporation must take into account their pro rata shares of the S corporation's taxable income, deductions, etc. This is a rigid allocation rule with no possibility of variation. The single class of stock requirement is consistent with this rule, requiring that all shares of stock in an S corporation have identical rights to distribution and proceeds of liquidation. Note that pro rata distributions among the shareholders are required. In the case of a non-pro rata distribution among the shareholders, for example, a 50% shareholder receiving more or less than 50% of the cash distributions in any given year will be considered creating a second class of stock, and thereby will automatically terminate the S corporation's S corp election. Requirement number 3 is that there be no more than 100 shareholders. When originally passed into law, Subchapter S only allowed up to 10 shareholders. This was later increased to 35 and then eventually increased to 100, suggesting that the concept of a small corporation has evolved over the decades. The rules for determining what a shareholder is for the purpose of the 100 shareholder rule are a little bit more complex and beyond the scope of this presentation. However, a husband and wife are generally considered one shareholder, but stock held by a partnership will mean that each partner will be considered an individual shareholder of the S corporation. Requirement number 4 is that only individuals and their trusts and estates can be S corp shareholders. As discussed previously, an S corporation is a tax accounting entity rather than a tax-paying entity that tracks its income, deductions, etc. in the manner of an individual. Therefore, consistent with that premise, only individuals, in other words natural persons, can be S corporation shareholders. Corporations and partnerships, including LLCs, cannot. Individuals do die, however. Thus, the trust or estate of a deceased shareholder can hold S corporation stock during the time it takes to settle the decedent's estate. There are also certain types of trusts that can permanently hold S corporation stock, and those are the subject of a different presentation. And finally, requirement number 5 is that there be no non-resident aliens. As the income and deductions, etc., of an S corporation pass through to its shareholders, to be recognized directly by them on their personal returns, It should go without saying that those individuals must be U.S. taxpayers. If some portion of an S corporation's earnings were allocated to a non-resident, non-United States tax-paying shareholder, then that portion of those earnings would escape United States taxation. Accordingly, only United States tax-paying individuals may own stock in an S corporation.